All right, financials ended the day higher today, but not Bank of America. BofA was down almost 4% in today's session. So what's going on there? For the answer to that question, we're going to bring in Zara Burton. Zara?
And Matt, this really has to do with the second quarter report due out on July 17th. Credit Suisse basically out with a report today and saying that everybody on the street is looking for a profit of about 8 cents a share on average. They're actually looking for a loss of 15 cents. And of course, the Merrill Lynch acquisition has much to do with this in terms of what's going on with their loss portfolio. But overall, they're also talking about that BofA is going to have to set aside more in terms of uncollectible loans. You're looking at about $7.6 billion. That's up from $6.9 billion in the first quarter. Bad debts as well included $1.9 billion tied to home equity, and about 10.4% of credit card loans are going to be written off. That's why you're seeing the shares fall today. They were down as much as 6%, 6.3%. They're, of course, pairing those losses, but the company, Credit Suisse, also reducing their full-year earnings estimates for the company.
So, Zara, a lot of companies outside of banks raised capital in the second quarter, obviously a ton of them. Wasn't that supposed to generate fees for a number of these banks, including BofA?
Yeah, and it did. In fact, Credit Suisse talking about the fact that in the second quarter, $1.2 billion is what they generated in investment banking fees. That's up 65% from a year ago, so that's huge. Plus, $4.5 billion in trading revenue. Of course, the trading environment has improved, especially given the strong performance in both equity and fixed income markets in the second quarter. And you have to remember, a couple of weeks ago, Morgan Stanley actually took up their estimates on this company because of this improved environment, saying that the stock is going to go to $32 a share. But Credit Suisse, today talking about these loan losses, and I know Adam is going to get into this a lot, but talking about these loan losses, that they will continue to be an overhang on this stock. They think the stock remains at about $12 a share because of that.
All right, Zara, thanks very much. So Bank of America has stolen the title of the world's biggest wealth manager from UBS. BofA managed $1.5 trillion as of December 31st, 2008. That's compared to just under $1.4 trillion at UBS. The rankings come from Scorpio Partnership in London. The survey ranked Citigroup third and Wells Fargo fourth. And Bank of America may have plenty of company, according to the latest government figures. Let's bring in Adam Johnson with more on that angle. Adam?
Yeah, bad loans, rising delinquencies. It's not what investors want to hear. Stifel Nicolaus has a report out this morning, and they're talking about a report that actually the Office of the Comptroller of the Currency released last week while everybody was on the beach, conveniently. They noted 2 points, two key takeaways here, Matt. Number one, prime delinquencies. Those are prime loans, not the bad ones, the good loans. Delinquencies are up 20% to almost 3%. Prime mortgages make up 2/3 of all mortgages, Matt. And number two, and this one, this is shocking, I think, even to, well, anyone would find this shocking. 36% of all of the Q1 modifications are now either delinquent or foreclosed.
So even if you 36%. Change the terms and try and bail these guys out, a lot of times they're going to go bust no matter what you can do.
Yeah, more than a third of them are now having problems. Take a look at this chart, Matt, because this puts it in perspective. This is mortgage delinquencies. You see, look at that spike. That is just unbelievable. And what's scary, of course, is that Stifel Nicolaus is saying it's getting worse. In fact, specifically, they say we are not out of the woods yet. That's mortgage delinquencies. Credit cards, as Zara was just saying, talking about Bank of America, problem there, too. The Credit Suisse report this morning lifted credit card charge-off rates across a whole host of names. Look at it. Citi was 11.5%. Bank of America, 10.4%. Wells Fargo, 10.3%. J.P. Morgan, 9.1%. These are credit card charge-offs. I mean, it's staggering, Matt. Those are high numbers.
It does not look good. What are analysts saying about this?
Yeah, they are saying, interesting, as bad as it sounds, they're not saying sell, but they are expressing caution on the regionals. The regionals, recall we discussed last week, sort of the canary in the coal mine. Twice in the past, they've gone down and led the market down. Pull up this chart, guys. Take a look at this. The KRE versus the XLF. These are the regional
KRE
banks.
In orange, XLF in blue.
Correct. The regional banks, the KRE, look at them trading down, the large cap banks trading up, and that's the problem. If the regional banks are leading down, you have a problem with the larger banks and the economy as a whole. And we're talking banks like Bank of Hawaii, Valley National, et cetera. That's the issue, Matt.
First Merit, Ohio.
Yeah, First Merit, Ohio. Yours, yeah.
All right, Adam Johnson, thanks very much.